All right, good morning. So we're going to be reviewing yesterday's price action. This will be a very quick video. We're going to be focusing on precision and speed while making this video so that it can be easily digestible and understandable because some things that will be discussed in this current video, it will be paramount to your development. It's something that you need to align yourself with. So we didn't trade the morning session because most our we came to the market at 10 a.m. yesterday doing yesterday's trading. So I'm trying to so yesterday's trading we rallied higher after 10 a.m. So we made this low at 10 a.m. Then price rallied higher, then took out buy side liquidity. When we have buy side liquidity like this, we anticipated this low to be taken during the PM session because we missed all of this trading and all of this sell position that occurred after 9 after the 9:30 is opening. Now we'll be discussing a few things. First and foremost, we'll be reviewing this PM session trade. Now, before we do that, I'm going to display the execution. So this was the execution for yesterday's trading. This was the execution. Now I know this is not what you are used to seeing. I try to show as much as my trade as possible. So if you get a few of these in this channel, it is okay because I am not a perfect trader. If you're seeking perfection, you're not going to get it from this channel. So I advise you to look elsewhere for perfection. Now, because the narrative I just gave you now from the morning session, we use that to trade the afternoon session going into the after the morning session. So during the afternoon session, we came to the afternoon session at 1 p.m. So during 1 p.m. trading, we had this rally higher, which was seen, and what I saw at the current settings of price action was this was the launch high and this was the launch low, and we're dropping lower to the launch low, meaning this was the obvious to me at that time. We're currently speaking in hindsight. At that point in time, this was the launch low. So the launch trading, this was the low and this was the high. And this was the sell side liquidity resting just at the left hand side of the launch low, which also you have this liquidity pool. So you have all of this liquidity pool, which you would understand that there is sell stops resting below these lows, which is sell side liquidity. Now, understanding this, going into the afternoon session, during the PM session, so we indicated that this price has already taken out this buy side liquidity and we are still seeking sell side liquidity. Hence, this would act as a breaker up, down, up, then drop lower. When you draw this down close candle out in time, this is your breaker. We have this breaker forming inside, we have another breaker forming inside of a breaker, giving us multiple reasons for us to go short. Now, this breaker setup occurred at 12:50. We traded into the breaker at 12:50 with this candle, traded into the breaker and then drop lower. But before we add this drop lower, price left this relatively core highs here. Now, because of the settings of the environment we are currently trading, you have to be conversant with the environment you are trading most of the time to understand what type of strategy, what type of tool you're going to employ when trading. When starting, it is good to start with a singular model, but as you get to trade and understand yourself more, you get to understand how to employ multiple models for multiple trade criteria. For example, the trade reasoning that was employed in my own inner musing while trading was that we've already taken out external range liquidity, and this was a form of an internal range liquidity. So we took this internal range liquidity here, and also price rallied higher again to take out internal liquidity, meaning we are seeking external liquidity because we have to pair up internal liquidity with external liquidity. I'm just stating my inner musings. Now, at 1 p.m., we had this rally higher. I am reviewing the previous day's trade session. So I would have to give you as I saw it at that point in time. So that is how it is. The logic is still valid. It doesn't matter we are not obsessed about the result of the trade. We are more focused on following a set of rules. Now, this set of rules, this is what guides you and protects you and gives you this level of confidence that you are at the right side of the market. Or it's not even about being on the right side of the market, that you are that rules because you have tested those rules and seen that it is an applicable rule that works in real life. You would know that this is the kind of lifestyle while trading you'd want to employ and adopt. So now at 1 a.m., at 1 p.m., sorry, we had this rally higher, failing to come for this relative equal highs. Then price dropped lower. When price dropped lower like this and took out, paired up these sell stops, which was resting here with the buy stops that was taken earlier. When price did that here, I personally took this high to this low. This is the equilibrium, sorry. This low to this high. If you take your fib, I only highlighted the equilibrium, which is this. I removed the other to make a clean chart. They only need to have all of the coordinates there. You only make use of the coordinates that you are interested in at that point in time. So we have that. So we traded lower to a discount, meaning we would have to go to a premium because for us to take a sell position, one of the rules is that we are to sell from premium PDRs, meaning we are the smart money, the algorithm, they prefer to crash this market than for them to buy at a premium. They prefer to crash this market than for them to sell at a discount. They only sell at a premium and they only buy at a discount. So with that logic in mind, I would want price to come above a discernible trading range, above the equilibrium, which means at a premium PDRA. So at 130, another criteria, you buy at true opening prices or below, and you sell at true opening prices or above. So at 130, we opened here and then dropped lower, then price rallied higher. Now, in my own personal analysis, I expected this rally to be a false rally, trying to pair up this buy side liquidity, which we did here. Price rallied to this buy side liquidity and to this breaker that was created during the launch trading. So this is a breaker, up, down, up. Now a breaker is not just a pattern. There's a lot of intricacies that goes into all of these PDRAs. A lot of you think you are just studying PDRAs, but the truth is you're studying more than that. But I'll leave that for another day. So, for example, this breaker, there's a logic behind this breaker. A breaker is not a breaker because it has higher lows and lower lows or whatever you guys call it. This doesn't mean this is a breaker. This is just a pattern. There's a logic that goes on inside of this breaker because there are traders that are already sold. So because they're sold inside of all of these sell candles, they are already fully confident that they are correct about price coming for these lows and all other lows. Now, price because of time price went higher to break this traders' will. Their will be broken from participating in this body of price action. So because they are currently correct in this sell position, if you take a sell position from this high here, let's say you took a source total soup NGG, took this sell, or you took this is a profitable trading range. If you sell from this after this breakaway gap, you sold from this balance price range lower to discount to this discounted PDRs, this imbalance, this breaker, and also this imbalance. All of these are discounted PDRs, meaning you move from premium to and cover up your sell position and buy it below discount, below the equilibrium. Now back to this breaker. I'll not dive too much inside of it. The reason for highlighting this breaker here is to tell you guys that you have to focus on the easiest set of models, the most popular set of models, because there's a reason why those models are popular. They are not popular because they are just popular. They are popular because they are the most easiest set of models to learn, like the fair value gaps, the other blocks, the breaker. Kind of the breaker block is not exactly as easy to learn as you think, but you get what I mean. These easier PDRs, these are the signatures that you, for your own benefit, you'd want to easily pay attention to, because you focusing on other PDRs like the Venom, the new one, and those are just new shining object syndrome that is being given to you. And sometimes a lot of the advanced students, they feel this is being done intentionally to weed out people that cannot concentrate on a particular set of models for them to be profitable before trying to learn what a what other PDRAs are trying to speak, what language, what interpretations those other PDRAs are trying to speak. The main thing is that they are just paying up liquidities. They are paying buy side liquidity with sell side liquidity. They are paying sell side liquidity with buy side liquidity. That is the market efficiency paradigm. So if you've not watched the market efficiency paradigm video, just search it up on YouTube, or you go inside of this channel and you look for the market efficiency paradigm. Once you understand that paradigm that goes on inside of the market, all of this will be easy for you. Now back to price. So at 130 we dropped lower and then rallied higher. Now me, because I was seeking bearishness, my joint liquidity was this relatively called lows. Yeah, I was seeking bearishness, even though I had this buy side liquidity tag yeah, because I expected external range liquidity to be taken, then price goes for this before price goes for this buy side liquidity. And as you can see, we failed to get to the low, yeah. Then price rallied higher once more to this relative equal highs. Then, from the market efficiency paradigm understanding, I paired my sell orders with this relative equal highs and sold, yeah, exactly at the high. Immediately the candle is making its high, I sold. Selling from here. Now, this is where you need to understand the idea of partials taking. You should know how to take partials, because this was my current personal mistake in this body of price action. I was thinking these two lows to be purged. When this was rejected here, this should have been an indication, but that was already imputed in the journal entry. This is also like a journal entry, so work with me. Now, price traded lower here to a discounted PDR, moving from a premium to a discount. From here, sorry, from here to here is about 4.6 handles. Let's say about 5 handles. 4 handles in the ES is how much? It's about $200 per handle. Sorry, in when you're trading a single contract. So this is about a $200 move. This is good for a day's work, getting out at 4 handles. But you see, because my invalidation point would be this consequent encroachment of this CB, the consequent encroachment of this BC, and also this imbalance here that was created here that is coupled with this volume imbalance. when you draw this out in time, this makes three PDRAs. Now, I would not want to see these three PDRAs be violated. Hence, my stop loss was placed at this PDRA, at this high, the eye of this candle, the eye of this rectangle here, sorry, which is this imbalance. So we have logic following our price, our execution. We are selling from a premium, trying to cover up at discount PDRAs, all of these discount PDRAs. Now, and as you can see, we entered from this other block. Also, again, expecting this to be an inverted level, failed to invert, then price came for our stops. Now, all of this went on after this low was taken, meaning this is indicating extreme bullishness in the further sessions that is going to take place. Meaning, when I say extreme bullishness in the ES, I'm talking about at least a 30 points move because we didn't trade below with a full, we didn't have any consolidation below this opening price. We just had this candle, a single candle, a 1 minute candle dropped lower to this low, dropped to a bullish order block, and then rallied higher. Leaves an imbalance here. You draw this imbalance out in time. Let's make this imbalance a purple color. So that was a losing trade for yesterday's trading, which is normal and part of the game. So we've already paid the cost. So price immediately our so stop loss was placed here at this high here were invalidated. Now if I was to trade again, because we've been three PDIs has already been invalidated, meaning we are going for the opposite direction of the market. So if I was to enter again, I would have waited for price to come below an old low, which is this low and also this low. So, and price did that, price came for the lows, stopped here, then rallied higher. See all of this bullishness. This is the bullishness that this 1:30 p.m. candle indicated. You have to understand that the understanding of these little principles, these rules that you give yourself, it will guide you to understand how long you have to hold for, how how short are you to hold these settings for. Because if we're to if these lows was to be purged, yeah, I would be completely bullish because the morning session already dropped excessively lower, meaning traders were going to these settings expecting lower price actions again, trying to sell. So price rallied higher, came here, traded lower, rallied higher once more from this other block here, created this relative equal highs, price created a low here, took out the low, pushed this low, traded inside of this BC and this CB, which is a balanced price range because it delivered sell side delivery and buy side delivery. It is of a balanced price range. Price traded to it, price traded to it here, and we got the fill above the equilibrium of this balanced price range. Then price rallied higher and then continued rallying throughout the close. So I hope you got something from this video. I'll talk to you on Monday. Would likely not trade the PM session, sorry, the AM session this Friday's trading because we'll be occupied with some other real life activities. So goodbye and good luck, good trading.